So you're welcome, guys. For today's lesson, we're going to be talking about the basics of Forex. So I understand that there are some people in this group, or there are some people who attend who are in this lesson that probably are not new to Forex. So for the benefit of those who are just new to Forex and who are newbies, I would want to take my time out to explain a little bit about the basics of Forex. Okay, so let's jump right into it, guys. So now, what is Forex? Forex trading basically means is the biggest currency in the market world. Okay, so it has existed since 1994, and each day the trading volume is over $5 trillion daily. Okay, so Forex, the short form of Forex is FX, which simply means foreign exchange. It's similar to other business. Okay, so and you can profit, and profits can reach up to 100% in the span of one day. Okay, so Forex is very, very profiting. Okay, so unlike what you might have heard about Forex, okay, earlier. So that's that about that. So now let's go to the history of Forex. Forex, began in 1973, but I don't really want us to dive much into that. You can go to Google or Wikipedia to check more about that, to check more information about that. So let's go to the next one. What moves the Forex market? Okay, one of the reasons is supply and demand. Okay, so just like any other business, for example, if you sell something in the market, you're either buying and selling, just like any other buying and selling business. The basis, or it's dependent on supply and demand, because for example, if you sell something, you want to get it at the cheapest rate, okay, then sell it at the highest rate so that you have more profit. So that's just the similar approach with Forex markets. Okay, so Forex, you might have been hearing of stocks and Forex. They are actually different things. Okay, so what's the difference between stocks and Forex? In stocks, traders buy and sell stocks, but in Forex, traders buy and sell currencies. So in Forex, you sell currencies. In stocks, you buy and sell stocks. Okay, in stocks there are thousands of stocks, but in currencies there are 6 main global currencies. Okay, so we're going to talk about that later on. Okay, so stock is a one-way market, while Forex is a two-way market. Okay, all right, so that's that about that. So the major currencies we have in Forex are the USD, that's the US dollar, the euro, Japanese yen, Great Britain currency, and so on and so forth. So we have a lot of them. Okay, so we have the players in the Forex market. For example, most banks that they also trade Forex. Okay, that's in fact one of the ways in which they all get their money. All right, banks, for example, they trade Forex every now and then. Okay, banks trade Forex every now and then. All right, so now these are the main currencies. There are a lot of currencies that can be traded in the Forex market. You have Canadian dollar, Great Britain pounds, the US dollar, the Swiss francs, the Australian dollar, the Japanese yen, and so on and so forth. Okay, and also you can also trade some other instrument. They call them instrument, like gold, like CFDs, oil, and all of those things. So we're going to talk about that later on. Okay, and there is also one thing called currency pair. Okay, in Forex, currency pair, that is you trading two currencies together. Okay, so the major currencies, the major currency pairs are Euro USD, GBP USD, USD JPY, USD CHF, USD CAD, AUD USD, NZD USD. So these abbreviations, they are currencies. Okay, they are countries' currencies. All right, so that's that about that. We also have cross currency pairs. Okay, so we wouldn't be diving much into it because today is just an introduction. All right, today is just an introduction class. Okay, so time to trade. The forex market opens from Monday till Friday, so it's just 5 days. Okay, it's just 5 days. So just take note of that. All right, so now we have time frames in forex. Okay, we have time frames in forex. I know that because we are beginners, some of us are beginners, we might not understand what all of these are, but by the time we go into the practical aspect of it, we are going to understand what all of these are and how important all of these are. But for the benefit of this introductory class or introductory session, we need to understand and just be attentive to all of this. Okay, all of this is going to make sense very soon. So we have the time frame, we have the 5 minutes time frame, we have the 15 minutes, we have the 30 minutes, we have the 1 hour time frame, we have the 4 hour time frame, and so on and so forth. So these time frames are what you will be using to predict the markets, because you're going to be doing your analysis. You want to know how the markets performed in a day, in a month back, in a day before, in a week, in minutes, and all of that. So all of the time frames, you have it there for your own use for the technical analysis in forex. Okay, so that's that about that. And also, like I said, we have currency pairs. Okay, and each of these currency pairs contain the base currency and the quote currency. Okay, but the difference between them is the spread. So the quote currency, which is the bid, then the base currency, which is the bid, while the quote currency is the asking price. Okay, so the difference between them is the spread. I just want us to take note of that. The difference between the bid and the ask price is called the spread. Okay, all right, so I'm going to talk about that much later. Okay, so every broker has its own spread. Okay, so what is a broker? Let me just dive into that. A broker is an intermediary between you and the forex market. So basically what that means is a broker helps you to access the forex market. So you make your fundings through the forex broker accounts. Okay, and we have a lot of brokers out there. We have the Octa FX, we have the XNES, we have the Deriv, we have XM, FXDM, and all of those. We have a lot of them. Okay, so I usually prefer XNES. That's why I asked you people to download XNES, because of their fast withdrawal and their tight spread. Okay, so I'm going to talk about that much later. So that's that about that. Also, there is what we call leverage in forex. Okay, leverage is a characteristic feature that enables your trading strategy by using loan money. Okay, so leverage is just like you having a capital that you want to use to trade, and you equally have an amount that you are required to trade with. So the brokers give you an opportunity to trade with a certain amount of currency in the market, or with a certain amount of money in the market. That is the leverage. Okay, leverage, that's what you call leverage. So we have the different type of leverage. You have 1:1, which is 100%, 1:50, which is 2%, 1:100, which is 1%, and so on and so forth. Okay, for most of us that might have opened our MT5 accounts or our broker accounts, we must have seen the place where we were asked to input leverage and all of those things. Okay, all right, so what is PEEP? Okay, please, I just want us to note down all of this, because it's going to come handy at the end of the day. Okay, so PEEP is percentage in profit. Okay, is the value of the change in a pair. So for every currency pair, you have a PEEP. You have a PEEP. So the difference between the market price, okay, is determined by the PEEP. All right, so I just want us to take note of that. All right, so I won't go much into details. Okay, so for now let's talk about take profits. let's talk about take profit. So what is take profit? Take profit is, let's assume you enter the market, or let's assume you're a trader and you want to buy something. You want to buy, you sell clothes in the Korodu market, for example, and where you used to get your market from, or where you used to buy your clothes from, maybe you purchase them for about 2,000 naira, to resell at 5,000 naira. So the 5,000 naira is the take profit. Okay, the 5,000 naira is the take profit. Then what is stop loss? Stop loss is, let's say you purchased a good for 2,000 naira and you are supposed to sell it for 5,000 naira. But what if there's a lot of supply in the market and definitely so many people are not buying the goods, but you have no option than to sell it at a cheaper price than you bought it, although you're going to be running at a loss, but it's not a total loss because you are risking an amount of money, okay, just so that maybe in case there is no demand for it, you can have something to bank with. So the stop loss is the amount of money you tend to lose from buying that goods, the amount of money you tend to risk from that good you're purchasing. All right, so that is going to come handy later on. We'll understand more about that. So for every trading market, for every market you enter, there is always an entry point, there is always a take profit, and there is always a stop loss. Okay, there is always an entry point, there is always a take profit, and there is always a stop loss. Okay, so let me check through my my Telegram group. For example, if you come to our Telegram channel, for example, you can see we always have, this is what signals look like, and let's see, there's always, okay, sorry, let me just type this one out. Okay, let's just do this. All right, so anyways, let's proceed. All right, there's always an entry point. Let me do that again. There's always an entry, which is the amount you are buying the market. There's always a TP, which is the take profit, and there is always a stop loss, which is the amount you tend to risk from, the amount of loss you tend to risk from entering the market. Okay, so these three parameters are very, very important. Okay, so we're going to dive much into that. Okay, so what else are we missing out? Okay, so let me just round up with the stop loss, the take profit, and stop loss. So basically, the price, like I said earlier, Forex is two-way, is compared to stock, which is just one way. Okay, Forex on the other hand is a two-way thing. So it's either the market is going up or the market is coming down. All right, so there is what you call buy and there is what you call sell. So you can profit in two ways. Okay, in Forex, you can either profit by buying or you can either profit by selling. Okay, so when you are buying in Forex means probably when you actually buy when the market is down and you actually sell when the market is high. Okay, you sell when the market is high and you buy when the market is low. Okay, so when you're buying when the market is low, that means you're predicting that the market is going up. And when you're selling when the market is high, that means you're predicting that the market will go down. That's why you're selling. So it's that simple. Okay, so sell, then you have buy. All right, so that's that about that. So now in a sell market, for example, in a market where you are required to sell, in a market where you are required to sell, so in a market where you're required to sell, for example, sell means you're predicting that the market value or the current price of a currency pair will go down. So you want to enter a sell. Okay, so for a sell there is always an entry point. Then there is always a take profits. This is a take profits point. It's CP. This is a take profits. There's always an entry point. Then there's always a stop loss. Alright, so this is for a sell, this is our entry, this is our take profits, and this is our stop loss. So for every sell, the entry price, for every sell, the price of the take profits will always be greater than the entry. So let's say you are entering the market at 100, the take profits will definitely be bigger than the entry, which is, let's say, 180. Then the stop loss could be 50. Okay, so that's that about that. Now on the other hand, let me erase all of this. Okay, so on the other hand, for a buy, there is always an entry point. There is always a stop loss, and there is always a take profits, which is TP. So if your entry is 100 for a buy, this is a buy market, for example, your take profits will be 180, then your stop loss will be 50. Okay, so the reverse is the case for sell. So in the case of sell, it's always different. So another thing I want you guys to know is this: for every, there is what you call, whenever there is sell, it is termed bullish. You say the market is bullish, it means there is a bullish movement in the market. Okay, sorry, there is a bearish market. Sorry, that's a mistake. Sorry, sell, the market means bearish. Okay, that means there's a bearish movement in the market. Then whenever you have buy, that means the market is bullish. Okay, that means the market is bullish. All right, so that's that about that. So in the next class, we're going to be talking about charting. We're going to be talking about technical analysis and some other interesting things. So this is just an introductory class. Thank you for joining me, and I will be signing out right about now. Thank you.